Good Sunday afternoon, everyone. I hope you're enjoying the weekend. It is Sunday, the 25th of September. And my apologies. I've heard from a lot of people who said, how come you haven't put out a video lately? Well, I may not have put out a video, but I've done a ton of writing on the blog. So I know some people don't like reading, sitting there and reading. They'd rather watch a video, which is, I'm one of them, frankly. I could watch videos on any topic. I don't love sitting in and reading stuff, but everyone's different. So let me say one, thank you for watching. I greatly appreciate it as always. If you like the video, please give it a thumbs up on YouTube. And if you don't, you can tell me that, as long as it's not a personal attack. I love constructive criticism. You can call me in the office. You can email me. You can make an appointment and stop by and we can sit and chat for a while, whatever you want. But comments and questions are always welcome. So today, and I should say, it's not as though I didn't want to do the video. And it's not like I say I don't have time. I was taking an online class that had a shelf life of I had to finish it last Friday, which I did, thankfully. So, and that was my primary focus on my to-do list besides my normal contact with clients and running the business. So now, got one big thing off my plate. I have to take a test that follows that class, which I hope to do, fingers crossed, this week, and then write a recommendation for a former intern, and we're off and running. So this may not be the shortest one. I know I normally try to keep them lately to one topic and a little shorter. I've had a myriad of questions and comments about the markets, what's going on, what should I do, what shouldn't I do. I'm going to do my best to keep this not from being a half-an-hour video, because a lot of people say, I can't stand looking and listening to you for half an hour. I get it. I hear it at home every single day. So, but I will be out of the office on Monday and Tuesday for Jewish holidays. So I wanted to get as much info out in advance as I could. And with that, let's just talk about the market. So if you've read, I try to publish on the blog at least 3 days a week. If you don't get notified Monday, Wednesday, Friday, you're on a different list. If you want to hear about it, if you want to be notified when I publish on the blog, usually Monday, Wednesday, Friday, there's a checkbox on the blog page. It's on the right side down a little bit. So feel free to let us know and we'll change you over to being notified. If not, don't worry, we'll reach out every week or 2 or 3 to let you know what we're thinking. So market-wise, big picture first. My theme has been, you know this already, sloppy, choppy, frustrating year requiring a lot of patience. I've said it, I think, every month and probably more often during the year. That still holds true. The magnitude of the decline has been greater than I first thought. And, that's on me. Will I get them all right? You'll know that's not true. So I won't, but that's the year I envisioned, and it's a little worse than I envisioned. But now we're into what I first said would be this potentially beautiful, golden, amazing opportunity, which would be October of 2022. Well, we have 1 week left. This is it. So the countdown to October has already begun. So the markets went down sharply into January. We bounced. We went down sharply into February. We bounced. We went down sharply into June. That June low was a low of significance. And what I'm going to say is that I'm going to do a lot of screen sharing. But first, I've got to. No, there it is. So, so my chart's a little messy. So I think this low in June, this is the S&P 500. This low in June was a low of significance. Could be a major bottom. Doesn't matter the label. I think one of the biggest mistakes people in my seat make is that they feel the need to label everything. Sometimes I just say, I don't know, or what I say is, I don't have strong conviction that this is whatever you're asking me about. And I'm honest about it. So the low in June, to me, was not the ultimate major bottom. I said at the time, it was a low of significance and a low that we should have a significant rally out of. But I didn't think it was the low from which we start some unabated rally a la 2021, 2019, 2013, 2009. I'm doing this from memory, go on and on and on. But the potential, the possibility for that kind of bottom comes in October. Again, we're almost in October. So we had this, multi-leg decline. This is what happens in a bear market. I mentioned it. This idea that when you're down 19%, it's a bull market, but 20%, that's a bear market. That is complete and utter nonsense. It's moronic. That's how and I'm sure I've mentioned that before, but it doesn't make any sense. 19.9% down is a bull market, 20.1% down is a bear market. And how is it actionable? So I like to say this, and I try to say this during the year. A bear market is a market where rallies are sold and they are more shorter term in nature. When you've got a steady progression of lower lows and lower highs, folks, that's a bear market. And we've seen that pretty much throughout the year. Yes, it's a little, it's not a quick and easy formulaic way to label a market. That's okay, because you can't put a formula to everything we do in investing. I'll say this, and I wrote about it in the summer. This rally into the middle of August regained more than half of what was lost. And historically, I think 90% of the time, when you've regained at least half of what you lost, you don't go back down to where we are now. You don't go back down to the previous lows. Well, guess what, folks? This is that 10% of the time. Nothing's ever foolproof 100%. Yeah, in August, I said, geez, we went a lot farther than I thought we would. Perhaps the lows from June will hold. I didn't think so, but I'm not going to tell the market's wrong. Well, I leave these blue things on my chart. I did an illustration for somebody, or I put it in the blog, and I thought this could kind of play out. And here we are. So markets have had a really rough run, and this selling wave has been 1, 2, 3, 4, 5, 6, 7, 8. We're 9 days into this selling wave. That's not a long time for a selling wave. So it could go on, and perhaps it will go on, but that's how long the selling wave. It's been pretty sharp too. So here's what we're looking for. If you've read the blog, I'm trying my hardest to keep it really simple in terms of what I'm looking for and what you should look for. Like this morning, one of my contractors came over to talk about some work outside of the house, and he always asked me about the market. And I said, look, two things, Bo. One, oh no, I'm wrong. That's not what I wanted. So here's the dollar. I mean, it doesn't take a PhD from Wharton to tell you that the dollar has had this meteoric rise. That means our currency is worth more in the world currency system, a rising dollar. And you may say, wow, that's great. That makes our standard of living better. That may be the case, but a strong dollar makes our goods really, really expensive. And also a strong dollar means that the world is kind of sort of scared, and they're moving to the safest currency in their mind. So that's not the greatest thing. Just because we have a small, like I know some pundits and members of the media always say, oh, strong dollar is always bad for stocks. That's the biggest pile of bunk, to use a different word, that I can recall. It doesn't make sense. I mean, markets do rally when the dollar is strong. Look, into 2019, we rallied. Markets can rally. Look at the bull market in the 90s. The dollar was insanely strong here. Look at this, 95 to 2000, insanely strong. Doesn't mean the market has to collapse. And then in the 80s, oh, I don't have that chart, too bad. But you'll see also a super strong dollar in the 80s and we had amazing bull market in stocks. I heard the other day that the strong dollar led to the crash of 87. You guys are smart. I know, let me dial it down. You tell me. I could be wrong. I could be blind or stupid. You wouldn't be the first person that called me that. But here is the crash of 87. All right. You tell me, is the dollar strong or weak into the crash of 87? It was at 130. And then by the time the crash came, it was at 90. The dollar was collapsing. So some clown on the media said, whoa, well, these are like the ingredients of 87. Fed's raising rates and the dollar is really strong. The dollar is not really strong. It's nonsense. So one of the problems is the dollar is really strong. So in order to get a super strong rally in the stock market, this chart has to look the other way. We need to see the dollar roll over. So if you follow the dollar index, you kind of got to get it down at least 3 to 5%, at least back in here, and then not have it go up again. That's a challenge. Why is it a challenge? Because the euro currency is in free fall, and you need to get the euro up to, I don't know, 102 at least, and now it's in free fall. So this is a problem. This tells me that the Fed likes to raise rates until something breaks. And what's breaking is likely offshore. What's breaking is likely in Europe. I don't know, is it Credit Suisse or Deutsche Bank? Could be, I have no idea. We're all just going to speculate. But we do know that we need the euro to stop collapsing. That's super, super important right now. If the dollar goes down, the euro goes up. That's just how it is, because they're inversely related. That's one. So you want to follow something, look at the dollar or the euro. You need the euro to rally and the dollar to go down. That's one. Let's go to number two. Okay, let's stop. Did I stop sharing my screen? Okay. Let me go to, where is he? I pulled up a slide and now it's not here. So that is not good. Let me pull up my other slide. Where's number two? There it is. Sorry about that. Let's try again, folks. Let's share this again. There's the 2-year note. Okay, so here's the 2-year note. And you'll see it closed at 4.11% on Friday. The 2-year note has to roll over and go down to have a strong equity rally. We're not going to rally in the stock market with the 2-year note going up like this. So again, was I right here? I thought the 2-year note was going to peak back in here in the 3% area. I did not see this last push coming. So I still say the same thing. You need the 2-year note to roll over. Clearly below 4, but I would say below 3.7-ish. There's no hard and fast number. We got to get that 2-year note rolled over. And that's important to get the stock market to bottom. And let me show you, there it is. Okay. So here you will see the 2-year note is in red, white, black, and that's, no, they show 420 close. I thought it was a 411 close, doesn't matter. And here is the Fed funds rate, what the Fed sets. So the Fed funds rate is up to 3.25%. The 2-year note is at 420. The Fed just follows the 2-year note. So the 2-year note is still going up. We need the 2-year note to curl over and then meet the Fed funds rate, and that will be likely the death knell or the end of the Fed's rate hike cycle. So we need the 2-year note to curl over and go down and cross below the Fed funds rate. Those are two important things. We have the dollar and the 2-year note. That will say more about equities than I think anything else. Again, I've targeted October, last month, I said we're 2 to 4 weeks away from what I think could be an amazing opportunity. Well, again, October's here in a week. So I'm looking for the stock market to bottom in October. All right, I'm planting my stake. October's been the single greatest bear killer month of any month in the calendar. Doesn't mean because we're in October, the market's got a bottom. In midterm election years, you typically see an October stock market bottom. Now, 2018, we saw it in December, okay? 2002, we saw it in October. 1998, we saw it in October. 1994, we saw it November, December. 1990, we saw it in October. You get the drift. So, and now that when we're declining into October, which gives us a little more comfort that if all this stuff comes together, there should be a major or a significant bottom coming in the month of October, with a good chance to kill the bear market. And I know I'm sure people argue, well, how can you kill the bear market? The economy is going into recession. Inflation is still high. Yes. The Fed right now is going to be embarrassed because the unemployment rate is going to go up above 4. So they're going to be hiking rates 0.75% into what will be a rising unemployment rate. The Fed is wrong again. I keep saying that the Fed is wrong again. Also, we're going to see the economy continue to weaken and slide into recession, probably Q1, Q2 of next year. Doesn't mean stocks will go down. The market normally bottoms before the economy does. The economy started rolling over in Q1 of 2022. I don't think they will look back and say recession began back then. I still think it's in front of us, but inflation, if you look on a month-to-month basis, inflation's dead. I know it's 8.3%. I get it. But on a month-to-month basis, the rises are super small. They are going to roll over, in my opinion, hard in the next couple of months. And we should be trending towards 8, 7, and 6%. So the Fed's going to raise rates as inflation really is rolling over. The economy is rolling over. Unemployment's going to go up. They're doing exactly what they shouldn't be doing, just like they were doing the same thing wrongly 2 years ago when they should have started hiking rates. So where does that leave us? Again, next 2 to 4 weeks, going to be bumpy and rocky and volatile. I can certainly make a case that 2 days ago, Friday, we saw some kind of, it could be, we may have seen a short-term low on Friday. We'll find out in the next couple of days, frankly. But I would be a buyer into weakness early this week. Is it the ultimate low? I don't sense that it is. I think it's, if anything, a trade for if you're nimble. And then we clean all this up in the next, again, 2 to 4 weeks. So what it should look like, it should look like, I'm going to pull up and show you what I think it looks like. So it should look like the market breaks the June low. We came close on Friday. We're not there yet. Market breaks the June low. A quick trap door opens up. Market quickly falls, and then we're cleaned up and we're done. But the keys are that, one, the rate of acceleration should be a lot less. The numbers should look a lot better than they did during this June free fall. What do I mean by the numbers? So let's look at something really quick and easy. The VIX, which is the volatility index. Again, the volatility index hit its highest level in January, and as the market went lower and lower, this never confirmed. And that's a sign that tells you you're losing momentum on the downside during the decline. By the time we reach the June low, generally speaking, the volatility index has been in a downtrend. And I would imagine that on this decline in the market, the volatility index does not go back above 40. I'd be disappointed, frankly, if it went above 40. That would cause me to rethink some of my scenarios. It may. If it does, we'll take that at that time. But I don't think it goes above 40. I think it stays below 40, which signals continuation of a less bad market, if you will. Okay. And I showed you the S&P. That's going to go to new lows. The Dow already went to new lows on Friday. So one index is already there. The S&P is not there. The mid caps new lows are not there yet. The small caps new lows are not there yet. And the NASDAQ 100, which is probably the most important index, are not there yet. Most of those or all of those indices will go to new lows, or should go to new lows in October. So finally, let me change screens and let's do, what do I want to show you? Yeah, let's do this. So screen share. The chart on top, this black one, is the S&P 500. It's the stock market. And the chart below is the percentage of stocks in well-defined uptrends, stocks that are going up. In June, the number of stocks in well-defined uptrends was 15. Is that right? It was 15-ish. So we're right there. Okay. So that means this, we really want this to stop right now going down. We don't want to see the percentage of stocks in well-defined uptrends continue to go down. That would make the acceleration on this decline worse. That's one thing to watch. Let's look at something shorter term. And in June, so the same thing in June, we're kind of right here. So I don't want to see a lot more acceleration in the percentage of stocks in uptrends, short and long term. Let me also show you, oh, I lost my train of thought. Oh yeah, new highs, new lows. So that's not what I wanted to show. That's not what I wanted to show. There we go. Okay. So the S&P, we're right at 1,100 new lows. I typically like to see this last low show fewer new lows. We're kind of sort of right there. So in order for this to work out, we need stocks to probably rally a little bit, take off some of the pressure. And on the final decline in October, less stocks make new 52-week lows. That's how it would play out in a perfect world. Is it a perfect world? No, it never is. And they never make it easy, but that's what I want. And then also, let's look at put call ratio. So where we are. This is really, really bearish. I mean, these are 102 means a lot of people are positioning for much lower prices. It's like the world is now woke up and discovered that the market's going down. Let's hedge and let's make sure that we don't get hurt. And that normally functions as a contrary indicator. When people position for the downside, we're normally close to it being over. So this is pretty negative. The only other negative time was in the middle of the COVID crash. So we're at the most negative since the COVID crash. There's a couple of other things I saw when I was running through my list of sentiment. And I think one was, find it. Oh yeah, the AAII. 61% of people in the American Association of Individual Investors say they're negative. You can't, I mean, at the COVID crash, it was 50 and change. This is the most negative reading since March of 2009. That, folks, means the world is bearish. Doesn't mean stocks have to turn tail right away. We can stay really despondent for a couple of days to a couple of weeks, but we're in that zone. And only 18% in the survey said they were bullish. That's really, really, really low. Again, doesn't mean we have to bottom today, but it means we're in that zone. So again, next 2 to 4 weeks, get rid of my cheaters. Next 2 to 4 weeks are going to be rocky and volatile. We should head towards a low of significance, maybe even a major low in October, perhaps the bear market killer low. And I'll leave you with this as it's getting long in the tooth. I appreciate you watching. I know I'm long-winded. Sorry. Try living with me, as my wife and kids say. So we're building towards that low. My 3 scenarios. 1, my worst case scenario for 2023, stocks go up 5 to 8%. That's my worst case scenario. My middle case is that stocks go up 15 to 20% next year. Middle case. My most bullish case is that from whatever low we reach in October in 2 to 4 weeks, we go up 50%, 50% over the next 14 months. Yes, I said it, 50% in the most bullish case in the next 14 months. I don't know the answer or the one I'm going to lean on yet, but as I went through all my numbers for the last couple of weeks, I'm like, next year's an up year. I have, so you want to talk about conviction? I have high conviction next year is an up year. How high the magnitude is yet to be determined. We want to watch the 2-year note. We want to watch the dollar. I think that determines how high we go next year. But we got to get through some chop and some rock between now and then. So I thank you for watching. I know it's been a long time since I did a video, but in a long video this has been. So thank you very much. For those who celebrate, I wish you a happy, healthy, sweet new year. And I will be back to you. I'll be back in the office on Wednesday, but I'll certainly be back on the blog. I'll try to do something tonight and without a doubt on Wednesday night. So enjoy the rest of your Sunday if you're watching this over the weekend. If not, have a great week. Talk to you soon. Bye-bye.